Disclaimer.
Picture this. You wake up one morning, check your portfolio, and silver has dropped 11% in a single day. Your heart sinks. The metal that hit an all-time record of $83 just yesterday is now bleeding red across every trading screen. Panic selling has begun, and the financial media is calling it a crash. But here's what they're not telling you. That same asset is still up 166% for the year. Think about that for a second. Even after this brutal correction, silver has more than doubled in value since January. Your retirement account would be thrilled with those returns. Your investment advisor would be popping champagne. So why does this feel like a crisis instead of an opportunity? Because something much bigger is happening beneath the surface, and Wall Street doesn't want you connecting the dots. This isn't just about one metal having a volatile week. This is about a fundamental shift in how money works, how nations protect their wealth, and what happens when trust in our currency starts to crack. Let me take you behind the scenes of what insiders are calling the debasement trade, the silent exodus from the dollar that's been building for years and finally exploded into public view in 2025. This isn't conspiracy theory territory. This is Federal Reserve data, Treasury Department reports, and the cold mathematics of our $35 trillion debt crisis coming home to roost. Here's where the story gets interesting. On the same day silver crashed, President Trump announced a full oil blockade on Venezuela. Now, you might be wondering what Venezuelan oil has to do with precious metals prices, and that's exactly the question that reveals the hidden mechanism driving this entire market. Think about how sanctions actually work in practice. When we cut off a major oil producer from global markets, we're not just punishing one regime, we're forcing entire nations to find new ways to trade outside the dollar system. Venezuela needs to sell oil. China needs to buy oil. But if they can't use dollars for the transaction because of our sanctions, what do they use instead? According to data from the Bank for International Settlements, alternative settlement systems have grown by over 400% since 2020. That's not a typo. Countries are building entire financial infrastructures designed to bypass our currency, and they're using physical commodities, like silver and gold, as the bridge. Pop quiz. What happens to the value of an asset when the world's second largest economy starts hoarding it as a dollar alternative? You're watching it happen in real time. China isn't just buying silver for jewelry and industrial use anymore. They're treating it as a strategic reserve, a hedge against the very real possibility that our currency's dominance is ending. Now let's talk about the elephant in the room, our $35 trillion national debt. You've probably heard that number so many times it's lost all meaning. Let me put it in perspective. If you started counting $1 per second the moment Jesus was born, you still wouldn't have reached $35 trillion by today. That's how much money our country owes. The Federal Reserve knows this math doesn't work. Treasury officials know it. Every economist with a calculator knows it. And here's the part that should grab your attention. They're choosing inflation over default. That's not speculation. That's explicit policy. Fed Chair Jerome Powell has said repeatedly that they will do whatever it takes to keep the system functioning, which is central banker speak for, we're going to print money until the problem goes away. But problems don't go away when you print money. They transform. They migrate into hard assets that can't be inflated away. They show up as 166% gains in silver prices over 12 months. Have you noticed what's been happening at your local coin shop? I'm not talking about the headlines or the futures markets. I'm talking about the physical metal you can actually hold in your hand. According to the U.S. Mint, American Silver Eagle sales broke records in 2025, with demand outpacing supply for 5 consecutive years. 5 years? Not 5 months? Not 5 quarters? 5 full years where more people wanted to buy silver than miners could pull out of the ground. Think about this scenario. You walk into a dealer with cash, ready to buy silver at spot price, and they laugh. Not because they're rude, but because spot price is a fantasy at this point. The spread between paper silver trading on COMEX and physical silver in your hand has blown out to levels we haven't seen since the 1980s. Major refiners are actually paying $7 under spot for generic silver rounds because there's such a shortage of refined product that they need the raw material more than they need the profit margin. What if I told you this entire crisis has a countdown clock attached to it? January 1st, 2026. Mark that date. That's when China's new export restrictions on antimony and other strategic metals take full effect, and the Western world has to confront a reality we've been avoiding for decades. We don't control the supply chains anymore. Silver isn't just a shiny metal people collect. It's in your smartphone, your solar panels, your car's electrical system, your laptop, your television. According to the Silver Institute, industrial demand alone consumes over 60% of annual mine production, and that number keeps climbing as renewable energy expands. Now imagine what happens when China, which processes over 80% of the world's antimony and controls significant portions of rare earth refining, decides they'd rather keep those materials for their own industrial base. You're starting to see the real story now, aren't you? This isn't about one day's price crash. This is about supply chains fracturing, currency systems shifting, and nations positioning themselves for a world where the dollar doesn't automatically win every trade. Let me connect one more dot for you. Remember when I mentioned the debasement trade? Here's what that actually means in practice. Sovereign wealth funds, central banks, and institutional investors are looking at our debt to GDP ratio, looking at our political gridlock, looking at the Fed's commitment to keeping rates low, and they're making a calculation. They're deciding that holding dollars long term is a losing proposition, and they need to move wealth into assets that governments can't print more of. Gold gets all the attention because it's traditional central bank reserves. But silver is where the leverage lives. The above-ground supply of silver is actually smaller than gold when you account for industrial consumption. Gold gets stored in vaults and treasuries. Silver gets consumed in products and thrown away. The Silver Institute estimates that millions of ounces are lost every year to industrial use, never to be recovered. So here's where we are right now, at the end of 2025, staring at January 1st. Silver just crashed 11% in one day, and the financial media is writing obituaries for the bull market. But the fundamentals that drove it up 166% haven't changed. They've intensified. Fed rate cuts are continuing into 2026. Trump's tax extensions are keeping deficit spending elevated. Geopolitical chaos from Venezuela to Ukraine is accelerating the shift away from dollar dominance. And on January 1st, China flips the switch on export restrictions that could turn a supply squeeze into an outright shortage. The real panic hasn't started yet. What you witnessed this week was profit-taking, leveraged positions getting liquidated, and weak hands shaking out of the market. But ask yourself this question. When institutional buyers finally woke up and started piling into silver in the 60s and 70s this year, do you think they did that because they thought the party was ending or because they knew something bigger was coming in 2026? The math is about to get very interesting. And the people who understand what's really happening are positioning themselves right now while everyone else is panicking about one day's correction. Let's talk about the numbers that Wall Street doesn't want you calculating on your own. The Federal Reserve cut rates 3 times in 2025. And according to their own forward guidance published in December, they're planning at least 2 more cuts by mid-2026. Now here's what that actually means for your purchasing power and why it matters to anyone holding dollars. Every time the Fed cuts rates, they're essentially admitting that the economy can't handle the cost of money at its natural level. They're subsidizing debt, making it cheaper for the government to service that $35 trillion obligation we talked about. But there's no free lunch in economics. When you make money cheaper, you make everything else more expensive relative to the currency. Think about your own budget for a second. Your mortgage payment might stay the same with lower rates, but have you noticed what happened to grocery prices this year? What about insurance premiums? Gas fluctuates, but the trend line keeps climbing. That's not coincidence. That's monetary policy working exactly as designed. Transferring wealth from savers to debtors, which in our case means transferring wealth from you to the largest debtor on planet Earth, the United States Treasury. Now add Trump's tax extensions into this equation. The Tax Cuts and Jobs Act provisions were set to expire, and extending them adds roughly $400 billion per year to our deficit, according to the Congressional Budget Office. That's not political commentary. That's just math. $400 billion that has to be either borrowed or printed year after year, piling onto debt that's already growing faster than our economy can expand. You know what thrives in that environment? Hard assets that can't be printed. Physical commodities with actual supply constraints. Things like silver that require massive capital investment, years of exploration, and enormous energy expenditure to pull out of the ground. You can't just decide to make more silver the way the Fed can decide to create more dollars with a keystroke. Here's where the proof gets uncomfortable for anyone still believing the official inflation numbers. The World Gold Council reported in November that central banks bought more gold in 2025 than any year since 1950. These aren't panicked retail investors we're talking about. These are the central banks of Poland, China, India, and Turkey, moving hundreds of billions of dollars worth of reserves out of paper currencies and into physical metal. And while gold gets the headlines, silver has been moving even more dramatically. According to Metals Focus, the global silver market deficit reached its 5th consecutive year in 2025, with industrial demand alone consuming 200 million ounces more than mines produced. Let me translate that into terms that hit home. Imagine if every year your grocery store sold more food than farms could grow, and that gap just kept widening. Eventually the shelves get empty, or the prices go vertical. There's no third option. Have you been following what's actually happening at the COMEX exchange in New York? This is where the paper-silver market trades, where big institutions bet on price movements without ever touching physical metal. According to their own inventory reports published weekly, registered silver available for delivery has dropped to levels we haven't seen since 2014. We're talking about roughly 40 million ounces of registered inventory trying to back up a market that trades billions of dollars daily. Picture this scenario. You're a major electronics manufacturer and you need silver for your production line. You've been buying paper contracts on COMEX because it's convenient and liquid. But now you actually need the physical metal delivered to your facility. You go to take delivery, and suddenly you're learning about delivery delays, quality issues, and premiums that weren't in the contract. That exact situation played out multiple times this year, according to industry sources, and it's creating cracks in the paper market's credibility. Now let me show you something that should make every investor sit up and pay attention. Major silver refiners, the companies that actually process raw silver into bars and rounds, started paying $7 under spot price for generic silver products in late 2025. Think about what that tells you. These are businesses that make money by refining silver and selling it at a markup. If they're willing to pay under spot for generic rounds, it means they desperately need the raw material more than they need their profit margins. The demand for refined product is so intense that they'll lose money on the purchase just to keep their operations running. According to a report from the Silver Institute published in October, solar panel manufacturing alone consumed over 140 million ounces of silver in 2025. And that number is projected to hit 180 million by 2027 as countries race to meet renewable energy targets. Your tax dollars are subsidizing this demand through the Inflation Reduction Act, which is pumping billions into green energy projects that consume enormous amounts of silver in photovoltaic cells. Here's what keeps me up at night about the supply situation. The largest silver-producing companies in the world, Pan American Silver, First Majestic, Hecla Mining, they've all published quarterly reports showing production increases. They're literally pulling more silver out of the ground than they did last year, and the deficit is still growing. Industrial demand is accelerating faster than mining companies can possibly keep up, no matter how much capital they invest or how many new deposits they discover. Think about the timeline on mining projects for a moment. From discovery to production, a new silver mine takes 7 to 10 years on average. That includes exploration, permitting, environmental studies, infrastructure development, and actual construction. You can't just flip a switch and make more supply appear. And right now, according to S&P Global Market Intelligence, there aren't enough projects in the pipeline to close the supply gap, even if everything goes perfectly for the next 5 years. What if I told you that while retail investors were panicking about price crashes in 2025, institutional money was quietly accumulating at levels we've never seen before? The World Silver Survey documented that investment demand from institutions jumped by 43% year over year, with the heaviest buying occurring after silver crossed $60. These aren't momentum chasers or retail stackers. These are pension funds, sovereign wealth funds, and family offices making allocation decisions based on multi-year outlooks. Let me paint you a picture of what that looks like in practice. A major Middle Eastern sovereign wealth fund doesn't call up a coin dealer and order silver eagles. They work with bullion banks to arrange physical deliveries measured in tons, not ounces. They lock in supply contracts directly with refiners. They build storage facilities and arrange security. This is infrastructure for long-term holdings, not short-term trades. And they started building that infrastructure in earnest when silver was trading in the 60s and 70s. Ask yourself why. Why would sophisticated institutional investors, with access to the world's best analysts and data, suddenly pile into a metal that had already doubled in price? Either they're idiots, which seems unlikely given their track records, or they're seeing something in the data that tells them the move is far from over. The geopolitical piece of this puzzle makes the monetary policy look almost simple by comparison. Venezuela's oil blockade isn't happening in isolation. According to Reuters reporting from December, Russia and Iran have already established silver-backed trade agreements with several Asian nations as a way to circumvent dollar-based sanctions. When we use our currency as a weapon, other countries build alternative systems, and those systems increasingly involve physical commodities as settlement mechanisms. Ukraine's ongoing conflict has disrupted palladium supplies, which has pushed industrial users towards silver as a substitute in certain applications. The energy crisis in Europe has made electricity-intensive metal refining more expensive, reducing European production capacity. China's zero-COVID policies earlier in the decade created supply chain bottlenecks that still haven't fully resolved. Every one of these factors individually would tighten the silver market. Combined, they're creating conditions we've never navigated before. Here's the part that nobody wants to say out loud, but everyone in the industry knows. The paper price and the physical price are starting to diverge in meaningful ways. You can see silver trading at $75 on COMEX, while dealers are quoting $82 for physical American silver eagles. That spread used to be $2 or $3 for premiums and dealer markup. Now it's $7, $8, sometimes $10, depending on the product and the dealer. According to data from Money Metals Exchange, one of the largest online dealers in our country, they experienced delivery delays of 4 to 6 weeks on certain silver products during the peak buying periods in 2025. Not because they didn't want to ship immediately, because the refineries couldn't keep up with order flow. And these are established refineries with decades of experience and significant production capacity. Think about what happens if that spread keeps widening. At some point, the paper market loses its credibility as a price discovery mechanism. At some point, buyers stop trusting that they can actually get physical metal at the COMEX price. And when that trust breaks, we enter territory that precious metals markets haven't seen since the Hunt brothers tried to corner silver in 1980. The difference is, back then, it was two wealthy speculators manipulating a market. Today, it's fundamental supply and demand backed by monetary policy that shows no signs of changing. The Fed can't raise rates meaningfully without crashing the government's ability to service debt. Trump's policies require deficit spending that keeps growing regardless of which party controls Congress. And the industrial demand for silver keeps accelerating as our entire economy electrifies and digitizes. You're watching the mathematical inevitability play out in real time. The question isn't whether silver prices will be higher in 2026. It's whether there will be enough physical supply available at any price to meet the demand that's building. And that question has a hard deadline attached to it that's coming up faster than most people realize. January 1st, 2026. Circle that date. Write it down. Set a reminder on your phone, because on that day, China's export restrictions on antimony and other strategic materials take full effect, and the Western world faces its first real stress test of whether our supply chains can actually function without Chinese cooperation. Now you might be wondering what antimony has to do with silver, and that's exactly the right question. Antimony is used in everything from flame retardants to batteries to semiconductors. It's not a household name, but it's in your phone, your computer, your car's safety systems. And China controls roughly 80% of global processing capacity, according to the U.S. Geological Survey. When those export restrictions hit, Western manufacturers face a choice: pay whatever China demands, find alternative sources that don't exist at scale, or reduce production. Here's where silver enters the equation. When manufacturing costs spike because of restricted materials, companies look for substitutes. When geopolitical tensions make supply chains unreliable, industries start stockpiling the materials they absolutely need. And silver sits at the intersection of both problems. It's an industrial necessity that's already in deficit, and it is increasingly viewed as a monetary hedge against the exact kind of instability that these restrictions represent. Think about this timeline. Chinese export restrictions go live on January 1st. Western manufacturers have maybe 30 to 60 days of inventory on hand for most materials. By February, companies that haven't secured alternative sources start feeling the squeeze. By March, if the restrictions stay in place and tensions don't ease, we could see production slowdowns in electronics, automotive, and renewable energy sectors. And every one of those industries is a major consumer of silver. According to analysis from Bank of America published in their December Commodities Outlook, silver could test $80 as a floor rather than a ceiling if supply disruptions compound throughout the first quarter. Let me be clear about what that means. Floor, not ceiling. As in, $80 becomes the bottom of the range, not the top. They're essentially saying that the volatility we saw this week, that 11% crash that had everyone panicking, might end up looking like a gift in hindsight if their projections prove accurate. But Bank of America isn't alone in their bullish outlook. Goldman Sachs Commodity Research, which accurately predicted silver's surge throughout 2025, released updated targets in late December, calling for $100 to $120 by the second quarter of 2026. That's not a typo. They're projecting silver could nearly double again from current levels within 6 months. Now here's what you need to understand about these projections. These aren't permabull gold bug newsletters or fringe analysts trying to sell you coins. Goldman Sachs manages trillions of dollars in assets. Bank of America advises the largest corporations and institutions on the planet. When they publish price targets this aggressive, it's because their models are showing conditions they can't ignore, and their clients are asking for guidance on how to position for what's coming. Let me walk you through their logic, because it's based on simple mathematics that anyone can verify. The Fed has telegraphed at least 2 more rate cuts by mid-2026, according to their December dot plot projections. That's monetary policy, continuing to devalue the dollar. Trump's budget proposals keep deficit spending elevated, regardless of who controls Congress. That's fiscal policy adding fuel to the inflation fire. And China's export restrictions create a supply shock right when Western economies need industrial materials most, and that's geopolitical policy tightening the physical market. You combine those 3 forces, monetary debasement, fiscal expansion, and supply chain disruption, and you get an environment where hard assets with genuine scarcity should appreciate significantly. It's not speculation. It's what happens when paper currency loses purchasing power while physical commodities become harder to obtain. Here's where the calculation gets really interesting. COMEX inventories, as of late December, sat at roughly 40 million ounces of registered silver available for delivery. Industrial demand alone consumes over 500 million ounces annually, according to the Silver Institute. That means COMEX has less than 1 month's worth of industrial demand sitting in registered inventory. 1 month. For an exchange that's supposed to be the global price discovery mechanism for silver. What happens if just a small percentage of paper contract holders decide they want physical delivery instead of rolling their positions forward? What happens if Chinese export restrictions create panic buying among manufacturers who suddenly realize they can't count on just-in-time inventory anymore? The system doesn't have the physical metal to handle that kind of demand surge, which means prices have to rise until demand destroys itself or new supply appears. But remember the timeline on new supply: 7 to 10 years from discovery to production. There's no cavalry coming to save the market in 2026. The mines that are producing now are the mines that were discovered and developed back in 2015 through 2018. The investment decisions being made today won't impact supply until the early 2030s at the earliest. Think about your own investment portfolio for a moment. Have you noticed how every correction in silver this year became a buying opportunity within weeks? The metal crashed in March, and by April it was making new highs. It pulled back in July, and August brought another surge. Now we've got this 11% drop in late December, and the fundamentals that drove it up 166% haven't changed. They've intensified. But here's the warning that nobody in the precious metals industry wants to say too loudly. This volatility is real, it's going to continue, and it can absolutely wreck your portfolio if you're over-leveraged or trading with money you need for living expenses. Silver isn't for the faint of heart. It's not a stable asset that compounds steadily like blue-chip stocks or investment-grade bonds. It's a speculation on monetary chaos, supply chain failures, and geopolitical instability. The difference between now and every previous correction is that this time we have a hard deadline with real consequences. January 1st isn't some vague future event. It's days away as we close out 2025. And the physical market has never been this tight going into a known catalyst. We've never had 5 consecutive years of supply deficits heading into a major geopolitical inflection point. According to proprietary research from several precious metals dealers who spoke anonymously in December, they're seeing allocation limits from major refineries. Not delivery delays, allocation limits. As in, the refineries are telling dealers, you can have X amount per month and not a single ounce more, regardless of what you're willing to pay. That's not a market functioning normally. That's a market approaching crisis conditions. Here's what should keep you up at night. If silver was up 166% with relatively normal market structure, what happens when the structure breaks? What happens when paper and physical prices diverge so far that the exchange loses credibility? What happens when manufacturers start panic buying because they realize their production lines might shut down without the material? The answer is probably prices that make $120 look conservative. But it could also mean a market so disorderly that normal investors can't participate effectively. It could mean spreads so wide that buying and selling becomes prohibitively expensive. It could mean a physical shortage so severe that even having money doesn't guarantee you can acquire metal. Think about the bigger picture for our country. We've spent decades building an economy based on cheap energy, reliable supply chains, and dollar dominance. All 3 of those pillars are shaking simultaneously. Venezuela's oil comes off the market, tightening energy supplies. China restricts strategic material exports, breaking supply chains. And nations around the world accelerate their shift away from dollar-based trade, threatening our currency's privileged position. Silver is just the canary in the coal mine for much larger structural changes happening in the global economy. It's telling you that the old assumptions don't work anymore. It's showing you that scarcity has returned to markets that spent decades assuming abundance. It's revealing that when nations weaponize trade and currency, the fallback position is physical commodities that can't be sanctioned or printed. You're living through a transition period that future historians will study for decades. The post-World War II economic order that made America the unchallenged superpower is evolving into something new, something multipolar, something where our advantages aren't automatic anymore. And in that transition, assets like silver that have intrinsic value and genuine scarcity become incredibly important for preserving wealth. So here's where we are as 2025 ends and 2026 begins. Silver crashed 11% in one day, and mainstream media is writing obituaries for the bull market. But the institutions that called this move accurately all year are raising their price targets. The supply deficit that drove prices up 166% is accelerating, not slowing. And in just days, China flips the switch on export restrictions that could turn a tight market into an outright crisis. The math is simple. The timeline is clear. The only question is whether you're positioned for what happens next. or whether you're still believing the same narratives that missed the entire move this year. This is not about fear or panic. It's about understanding the game being played at the highest levels and making informed decisions about how to protect your wealth in a world where the old rules are rapidly changing. The people who understand this aren't running around screaming about the end of the world. They're calmly allocating resources, building positions, and preparing for a 2026 that looks nothing like what most Americans are expecting. And they're doing it while everyone else is distracted by one day's price action, missing the forest for the trees. The real story isn't the crash, it's what comes after the crash. When the dust settles and the fundamentals reassert themselves, that's when the calculations we just walked through either prove prescient or prove wrong. And based on everything we know right now, the Fed's policy, the supply deficits, the geopolitical tensions, the January 1st deadline, the smart money is betting on prescient. Your move.